Hello, everyone, and welcome to Macro Ace with your host Tony for the EIA inventories report that you can trade with us. Hopefully, everyone can hear me and can also see my screen as well. Let me know if anyone in the chat or anyone who's currently listening at the moment or watching isn't able to see the screen that I'm showing or isn't able to hear me. We've got about 5 minutes. Just want to do a quick sound check just to make sure everyone that my voice is crystal clear and you can hear me loud and clearly. Can't let me know in the chat. Who do we have anyway? Who do we have today? Who is joining us for the stupendous EIA inventories? I guess that's whilst we've got, as I said, we've got about 5 minutes. We've got a bit of ground to cover today in regards to sentiment, as we always do. Since we've actually started this, we've had a lot of different bits of sentiment that have been weighing in on the markets. But just whilst we're waiting, just bear in mind you've had some recent comments from Fed's Harker. This is not to do with EIA inventories, but just something that if you are keeping an eye on, or if you're not keeping an eye on the financial news feed, that we do have, that Fed's Harker doesn't see high inflation leaving quickly. What else do we have? Just making comments about the economic outlook. Saying that we are acutely disturbed about far too high inflation. I'm worried about the inflation expectation will become unmoored, and he expects the Fed will begin decreasing its balance sheet soon. All right, we've got about 4 minutes. I think we might as well start going through this now here. If you can't hear me, do let me know and ping a message in the chat. So EIA inventories, what is it? So this represents the weekly change in crude, gas and distillate inventories, and the key areas in the economy that are affected are within the transportation sector, and also consumer prices can be affected as well for a number of goods. Remember, a lot of goods are made from oil, so you've got your plastics, so and just being one of the major products that are made from oil. So the higher oil prices go, the more expensive things can become. And of course, for natural and of course for consumers, for consuming when they go into the petrol station or the gasoline station, let's say, or the pump, then if prices become higher or see an appreciation, then those retailers might decide to increase prices further. So just to bear that in mind, that with crude oil inventories, the reason why it's an important release to be aware of and to keep an eye on for is the main reason that it can affect everything. As we've also seen with the Ukraine and Russia conflict, and when the crude oil markets have been very choppy and demand has been quite high, that consumer prices, particularly in the, of course, energy in the inflation reports in the European Union, has been the main driver of inflation overall. And also something that the Federal Reserve has kept an eye on too, not specifically to do with how many inventories have been added, but more so the impacts or the effects of higher energy costs being passed on to consumers, and that leading to higher inflation overall. But that's why it's important to be kind of aware of, and more so the EIA inventories itself can be very volatile bit of data that can be traded. Usually when there isn't a lot of choppiness going on within the oil market, as we've seen recently over the last month or so, and also a bit from today, then usually we can get some quite nice moves where we can see sometimes at least where we can get at least $1 or $2 move from EIA inventories if there's a huge draw, if there's a huge build. So it can be quite a volatile trade when we're keeping an eye on crude oil prices and how the EIA inventories data can affect that. So that's one of the reasons why I think it's nice as a weekly release to be able to see that. And it has that nice volatility that comes with it. But let's go on to our next bit. Does that make sense to everyone so far? If that doesn't, do let me know if that doesn't make any sense, and then we'll kind of go through it again. Okay, so let's carry on then. So again, I said whilst a volatile trade, there we can see quite strong moves from the report if there's a big deviation that we see. So how does it affect the markets? So for crude oil inventories and all, when we're looking at that, usually the headline figure, when more oil is added, that is negative for oil prices. So WTI crude oil and Brent would see a depreciation in value and see a move towards the downside. Usually it's quite a short term, quick reaction, or sometimes depending on how much of a build or how much oil has been added, then it depends on how long that effect can last. And then on the flip side, the less oil added, or when there's a draw in oil inventories, not only in crude oil inventories, but also bearing in mind the other gasoline and distillate inventories data that we get, it can be positive for oil. Of course, the less oil that there is, the more demand and the higher the price goes for crude oil in the markets. So just to, as a nice and easy and very basic way to understand how if there's more oil added, then crude oil prices can go down, and if there's less oil added, crude oil prices can go up off of that there. So again, remember supply and demand. I've also mentioned it last week as well. I'll go over it again. The more demand that there is for crude oil, the higher the prices can go, and the less demand for crude oil, then lower the prices can go. And that's one of the things that I want to talk about sentiment-wise today. It's quite key for the oil markets with Saudi Arabia and what they've been doing with their official selling prices to the rest of the world. But before we get into that, just want to go through some of the triggers then. So crude seeing a high estimate of about 1.5 million with a low of minus 3.5 million. If I just get the financial juice website here up as well, and then we can watch it together and we'll compare the forecast figures to the triggers. So crude estimated with a high estimate of 1.5 million with a low estimate of minus 3.5. Again, today's crude oil inventories data we're expecting a build of minus 2.9 million with a prior of minus 4.449 million. Gasoline inventories expecting a draw there of 0.3 million with a prior of 0.785 million. And with a high estimate of 1.5 million and with a low of minus 2.916 million. Again, these are estimates according to economists and where they see the EIA inventories coming in. And then for distillates, we've got the forecast for a draw to minus 0.55 million with a prior of 1.394 million. And then a reminder with the distillate the highest estimate that we're looking for is 1.5 million, and then with the low estimate of minus 2.482 million. So that's the data that we're expecting today, and those are the triggers that we have, or that that economists have. I think also one thing we would also want to make sure is when we look at the deviations that we had seen in the past. Now, I've put together, if you're not sure what I've done here, then what I've done is I've done a weekly. That shouldn't have anything. That's for next time. What I've done is I've put in the data for every single week for crude and gasoline distillate, and I've measured the deviation that we've seen from the actual figure compared to the forecast, and then measured how much of a move that we've seen in the past from the figures that we've had. Now, what we've seen in the past, and this is before we even started doing macro ACE, is that usually with about a five about 5 million 5.0 million deviation, or at least 5 million deviation from the forecast figure just for the headline crude oil inventories data. What we've seen is that there have been strong movements, or stronger we've seen at least a strong movement or reaction, initial reaction from crude oil inventories data. So we've had in the past where there's about 70 ticks towards the upside on crude, or about 70 cents. And then for, if we're looking at some other bits of data too, so going prior to the Feb, when we had the Ukraine-Russia conflict start, prior to that, seen about and when we didn't get our deviation of about 5 million, we had seen about quite a weak move from WTI crude oil. Where sometimes even with, and bearing in mind there are other bits of data too together, hence I've added those other bits of data here as well, where we see again, but not really a strong reaction from crude when we don't get that 5 million deviation at least from crude oil's data. But if we're looking at recent bits of data then, so if we go back to so if we're going back to March the 30th, so ignore that little bit there. If we're going back to March the 30th, what we had seen is that there was a deviation of about 1.499 million. So it was a draw on the forecast, but the overall data that we had seen was more of a build that had come in. Well, we had seen gasoline and distillate seeing a build of at least 2.5 million for each of those releases. So the initial reaction that we had got was that we had seen about 22 ticks towards the upside, with the initial reaction of crude seeing a bit of a draw. But overall, with the market, when we had seen the other two bits of figures, when there was more of a build in inventories data, then we had seen about 59 ticks towards the downside. But the market reaction was quite interesting. The reason being is because the main reason being is because it was very, very choppy, and there was we didn't get a nice clean reaction. So on the same candle, and I'll bring up the video here actually for you. On the same candle, we had seen a move to about 20 cents towards the upside, and then about 60 cents towards the downside, and then back up to where the candle had started. So again, it was a very, very choppy and messy released trade. And we didn't get a clean break. Well, we didn't see at least a 5 mil deviation on the headline figure, but we'd seen a more of a build overall. So if we see similar data today, where we get let's say where we get the headline figure that shows a build, which is what is expected today. If the headline figure shows a build, but the other two figures show that there's a draw, and we get if we get at least 3 million, I think, of a draw from what we've seen in the past, then I'd expect then what could happen is we could get a similar reaction where we see crude oil potentially moving towards the downside initially, but off of the bigger draw in the report overall, we could see crude move towards the upside. But so that's one scenario. Okay. Second scenario is where all the bits of data come in as a build. Then we'd expect to see a stronger reaction from crude oil. We would see some movement towards the downside, or depreciation in crude oil, in WTI crude oil, and then vice versa. The third scenario is if we get all bits of data showing that there was a draw or an overall draw, excuse me, if there was a draw outright across the 3 releases, then we could see further appreciation from the market or from WTI crude oil. When we did get that, we had seen about 40 ticks towards the upside, or about 40 cents towards the upside on WTI crude oil. So one of the things that we need to be aware of, though, is, and the reason why, actually, let me get the video up for you. I did say I would show you that reaction. Smooth that there, and I'll bring it up here. Okay, so if I just see, if I go ahead. So that's the past bit of data. Okay, so let's go back a bit. All right, so about a couple of seconds before the release, we're looking at our crude oil. We're looking at our micro crude futures on WTI. Okay, there we go. So data headline figure came in as a draw. Then the other bits of data came in as a build. So we'd seen that initial, so again, movement towards the downside here on WTI crude oil, even though we'd seen a little bit of a movement towards the upside there. Again, now here we go. Here's where it starts to become a bit more choppy. Now, the reason being is the headline figure was a draw, but overall there was a build. So the market's at this point seeing some uncertainty as to which way to go. And then also, I'm just keeping an eye on crude there. So tick strike, also, if you haven't used tick strike, that can also be quite useful to see which way, how much buying or listen to order flow of buying or selling that's going on in the markets. So even tick strike was being quite choppy here, but again there, so about 22 ticks towards the upside, and then about 59 ticks towards the downside. So that's where the candle finished overall. So again, more of a mixed choppy reaction on the initial candle. So we could, from what we'd seen last time, where we had seen the other 2 bits, the headline figure came in as a draw, and the other 2 bits of data came in as a build. We could see more of a chopper reaction where we do get a move. We could see an initial move towards the upside a little bit, and then a move towards the downside to factor in that there was actually more of a build. And then, as we can see, after the release has essentially been done, or has essentially come out, then we'd seen a further move towards the downside in crude oil prices there. So that's something just to be aware of. That's with crude data. That again, as said, the other 2 bits of data come in as a build or a draw, and the headline figure comes in either way. We could see more of a choppy reaction in the reaction on crude oil. Going back to the, let's just close that now. I think I've heard my voice enough. Going back to the slideshow now, we've got about 17 minutes. So API data can be quite key to understand or to expect for the release that we have coming out today. The reason being is API data is private data that is provided to the market, showing if there was a build or draw in inventories. So sometimes traders, they can use it as an indication, as said, for what can happen the following day. And not all, the reason why it's not always trustworthy or reliable, let's say, or has mixed reviews or mixed thoughts, is because sometimes if API data shows that there was a build or draw overall, that can lead to the following day where we see a similar where we see similar figures where there was a build or draw compared to the API data the night before. But that doesn't always happen. But I think it's still quite key just to bear in mind what was expected yesterday and what had happened and what the actual data was. So if we're looking at API data, so US API crude oil stock change came in at a build of 1.08 million, and the forecast was for a build to minus 2.056 million. So much higher than expected. Also compared to the prior of minus 3 million, a bigger draw there in API crude oil stock change data. Then for API gas stock change, we'd seen the data come in as a build as well compared to the prior, minus 0.543 million. Prior was minus 1.357 million. Distillate stock change seen a forecast, had seen a similar reaction as well. I'd also seen a build of 0.539 of 593 million with a prior of minus 0.826 million. So overall, API data was showing a build in inventories data, again, private data. So what was the reaction from the markets? Now, usually at around 4:30 p.m. Eastern time is when the data was released. Yesterday, API data was released about 15 or 20 minutes later, so it's quite delayed. There wasn't a reaction at all to the data when it had come out. Now, usually what happens is the night before we get the EIA inventories data, there can be a reaction, or we often do see a reaction on WTI crude oil. But last night we didn't. So could that mean for EIA inventories today that we could see a similar reaction where we don't get a reaction if we meet our deviation of at least 5 million on the headline figure? That's one of the things that's going to be quite interesting to see. I think if we didn't have a reaction from API, we might not get a reaction today from crude oil inventories data. But that doesn't mean that we still can't get a reaction today from the EIA data. So sentiment is one of the other things that I want to. So again, March 23rd, there's a draw overall. There was strengthening, but not strong initial reaction. March 30th, there's a build overall, but WTI were absorbed. So sentiment is very key, as it always has been for a long time, and also, of course, especially since the Ukraine conflict and how that's affected crude oil prices. I'm just bearing in mind today that there isn't any major, huge bits of news that have come out that has distorted the crude oil market. Currently, at the moment on WTI crude, we're up about more than 1.2%, or at $102, or around that price there. So overall, the market hasn't been extremely choppy, or we haven't seen some really strong moves in WTI crude oil. It's more or less been tame, compared to, if I bring up the chart here actually. So today, that's our reaction today. Oh wow, that's our market today, or what we currently see at the moment. There isn't too much that had happened. Actually, the only bit of news that did happen today was that the EIA said that they're going to release 120 million barrels of oil to ease prices, with the US providing half of that, so 60 million, and the rest coming from EIA members, according to people familiar with the matter. So that was released around 9:30. And if I just bring up the chart, if I bring it here, so we'd seen a depreciation in crude oil prices around that time, that bit of news there. But again, so that's one of the bits of sentiment to be aware of, just from today's bit of news that we had seen. But overall, not as strong as a reaction or strong as a movement as we have seen compared to the prior day with the crude oil market, as it hasn't been too much to affect the report of the market today. Going back to the rest of the sentiment as well. So there was news yesterday that the EU is working on new sanctions, which sent oil above $100. Again, that's in regards to, of course, sanctioning Russia more, to try and deplete, according to the US, their reserves and their resources to be able to fight Ukraine in this conflict that they have created. So that was one of the business sentiment from yesterday to be aware of. So that had caused an appreciation in the crude oil market. And then one of the other things as well, and then you had Aramco raising the official selling price for everyone. Just a reminder that 60% of Saudi oil goes to Asia, with China, Japan, South Korea, and India leading the buys. So if we're looking at surging prices and a chart here from Bloomberg, it shows that the price for Asia was set at $9.35. And if we're looking at it on the chart here, we can see at the beginning of 2022, whereas around $2, right, whereas nice and stable compared to pre-COVID levels, then we had seen this huge rise or huge price increase. One of the main reasons being is that you've got to remember that Russia is a provider for Asia as well, or is a big provider for Asia as well. So when you have a depreciation or a loss of that supply, mainly because some countries feel that if they do take Russian oil, that they would be seen less favorably in the world market or in the world politically by the nations. Then you have the surge in demand for other areas where these countries can get crude. So with the Saudis and Aramco, if they've hiked their prices by quite a bit, then that does not bode well for the rest of the global economy. Of course, the higher the price that these countries are paying for crude or these natural resources and commodities, the more likely that will pass on into inflation for consumers, or high inflation for consumers. Okay, as said, if crude prices go higher, then that raises energy costs, not only for consumers but also governments as well, and businesses when they're providing services or goods. So overall, having higher prices we had seen some appreciation in crude oil prices. Again, this market is very choppy and mixed. It's schizophrenic. it's it's a mixed bag altogether. Then Russian oil also being offered with steep discounts could cause further pain for the Middle East. Now, as said, if there is still a demand for Russian oil, but nobody else around the world wants it due to the political stigma, then the cheaper oil could mean that it's like, well, hold on, we have cheaper oil, which is, compared to the Saudis, much better. Then that could lead to an increase in supply of the oil, which could bring down prices of crude, WTI crude oil overall, or crude oil prices overall. It could have a negative effect. Or what we could see is a bit of an oil price war between Russia and Saudis. Although I think now, in my personal opinion, I know I try to stick to facts as much as I can. I don't think having a war between Russia and Saudis price-wise in oil is going to happen, considering that the Russians are more focused on Ukraine, more so at the moment. So there isn't, and for the Saudis, they've already hiked prices for the rest of the world. So they don't they're not really focused on Russia's prices for their crude oil. Going back to other bits of sentiment as well, so state-owned companies including Sinopec and PetroChina are in discussions with suppliers to buy spot cargoes from Russia at a deep discount, according to people with the knowledge of the matter. Got about 6 minutes until the release. March 24th, we had news that India has so far bought 13 million barrels per day of Urals and, 13 million barrels of Urals from Russia and 5 million in its latest tender. And then other bits of news as well, slightly older. The US said last week that they're going to be releasing 1 million extra barrels of oil a day for the next 6 months. And we've seen a depreciation in crude oil prices, or what we did see to the point where there's about a 7% decline off of the back of that news that we had seen. Where beforehand you had the US looking to release more oil from their reserves. And then 6th of April, so today we had US allies already said they're looking to release more oil into the market. And today at the moment, we did see some movement towards the downside on crude oil prices. February crude oil exports fell to 3.31 million barrels per day from 3.32 million barrels per day in the US. So again, less being exported, or less was exported in February, but I think with that, like, or with the data that we get for next month, or for March data, for we do get it this month, then I think we could see more of an actual, could see more being exported of oil to other nations. COVID outbreak in top oil import in China is hurting energy demand, as cities, including Shanghai, have been placed under lockdown. Remember, they're doing more of a, Shanghai is doing a controlled lockdown where they're cutting off certain sectors, certain areas of the city and then opening them back up after they've done their testing. And they've seen a drop off in COVID cases. But so far, China has reported 20,000 new cases for Tuesday. Remember, there was news over the weekend, actually on the Sunday, when China had reported about 13,000 cases or new cases over the Sunday. So seeing that increase there, which means if there is any further strengthening of the lockdown in China, then that could have a further impact on crude oil prices. Again, that's one of the other things that's driving the markets at the moment. We've got about 3 minutes to the release. Then investment bank views. So in regards to the OSP being raised by Aramco for Asia for May, they're just saying it's a massive increase, again, as shown on this chart here by Bloomberg, of the official selling price of the Saudis. So again, even for the US, seeing that price increase since beginning of the year. Well, actually, it's not been as steep of an increase as we've seen for Asia. We've got to bear in mind that I think with the for Asia, they have more reliance on Russian energy. Of course, the US wouldn't, and the US wouldn't have that much of a reliance on Saudi oil as well. So even though prices have increased, they haven't increased as steeply compared to prices for Asian nations. Okay, so we have about 1 minute left, and let's bring up our feed. Okay, all right. So we got our crude tick strike there. Got our crude oil data there. Less than a minute now to go. So remember, just to quickly go over it then, if we see the headline figure showing a draw, but the other two bits of data showing build, well, let's say if we're seeing a build and the other two bits of data showing a draw, we could potentially see a bit of a whipsawing of the initial candle. We could see some movement towards the upside, or that could potentially be the case, and then some movement towards the downside. But we've got about less than 10 seconds to go, so let's see what happens. Okay. All right, so 2.421 million. That's a build in the forecast of minus 2.9 million. Gasoline inventories showing a draw minus 2.041 million. A draw in the forecast of 0.3 million. And distillate inventories showing a build of 0.771 million. A build thereof on forecast of 0.55 million. So crude oil seeing some movement towards the downside here off of the data showing more of a build on the inventories, with the headline figure as well coming in there. We also keep an eye on our triggers and deviations. So the high, so that's much better than the high estimate that we had. So the high estimate we had was 1.5 million, so that was much better than expected, or was much higher than expected. The gasoline inventories, if we're looking at the draw, the lowest estimate was minus 2.916 million, so not completely reaching that there, or the estimate that we had on our side. And then the distillate, again, not closer to underneath our high estimate of 1.5 million, but again still showing a build there in the data. Okay, so let's see how many ticks we've got so far on this bit of crude oil inventories data. Right, so that's about 43 ticks, or about 43 cents. So still, I'm looking at tick strike. Okay, some buys coming in there. I think what I'd also want to see is how the rest of the market is reacting. Okay, no other reactions from the rest of the market. All right, so still seeing some weakening on WT on the crude oil bit here that we're currently seeing at the moment on crude oil futures. Again, overall more of a build on the data, and did see, so if we measure, so now that movement, so it's about 56 cents, or about 55 cents now towards the downside. What we've seen so far is the low point after that release. Oops. Okay, ladies and gentlemen, thank you very much for jumping on and watching the EIA inventories data. If you do have any questions, do email me at tony@financialjuice.com. I'll put it in the chat for you. Okay, and if you want to see the replay of this video and stay up to date with what to expect for the week ahead, when for next week, then you can also sign up to our mailing list, where you can stay up to date with what we're doing. If you do like what we've provided for you today, then again, then if you like what you see, then jump on and subscribe to that mailing list. Also subscribe to our channel too on YouTube, and give us a like on Twitter. And any feedback on what I've done here today, or any bit of knowledge that you want me to cover off or explain or improve on or make, be better, or if there's anything you want me to do better, then let me know. As I said, you've got my email there now, so you can email me there, and I'll try and answer your questions as best as I can. But for now, thank you very much for joining, and I will catch you for Friday when we get the Canadian employment data. All right, goodbye. Thanks.